What's up guys, it's Drew. I'm going to do a video on dividend ETFs today, specifically on QYLD and the trade-off it has on its underlying, which is QQQ. So I'm probably going to call it, Q yield and just the Qs because, saying the underlying ticker is like a tongue twister. But anyway, so, a lot of YouTubers have been talking about how Q yield gives us, 12% monthly dividend, right? But it's actually not 12% monthly dividends. When we look at the NASDAQ dividend history, right, you can see here it averages about 22 cents per share. And Q yield itself is trading at 22.52. So 22.52, 22 cents a share, right? So essentially you're making 1% a month. And where they get that 12% number is because, there's 12 months in a year. So when you add up all that, you get 12%, but it's actually 12% on the year, not 12% monthly dividend payout. You actually get 1%. But I mean, that's still really good passive income, right? So say you have 500,000, 1% of that gives you $5,000 a month that you're making off of Q yield. And it's actually not going to be $5,000 every month, potentially more, right? So say Q yield doesn't do anything and it just hangs around here, so you don't lose money on your entry, right? And I'm going to touch base on that in a little bit. But so 500,000 times 1%, you get that $5,000, right? But the next month, you're at $50 more, if you notice, right? So it's $510,050. And if you do it again, you get more money. So I did a little quick math to kind of just visualize it. So here, first month, you get $5,000 on your 1%. But the next month, since you have more money, this 1% will give you more, right? So you actually make $50 more. Again, third month, now you have more money than before. Your 1% will give you more. So this time, you get $5,100 instead of the $5,000 we initially started. So if you keep doing this, you can see how eventually you'll be making more than just $5,000 a month. It'll continue to compound and grow, right? But like I said, what are the trade-offs? So we have to always do our due diligence, right? So Q yield, you get capped gains. And what I mean by that is when Qs are running, because of the nature of covered calls, you don't get the full move. And I'll show you that in the chart perspective later, so it's easier to visualize. And you're also still exposed to the downside of the market. When the market pulls back, Q yield will pull back too. But even though it does pull back, you still have some protection. So I'll touch base on that as well. And your monthly dividends, right? Depending on which account you have, if it's on a regular taxable individual account, it's not gonna count as long-term tax gains. So instead of a fixed amount like 15%, so say you invested 100K into the Qs, and now it's at 150K and it's been a year, right? You're only taxed 15% of that 50K. But because this monthly dividend pays you out every month and you don't get to wait that year for long term, you're getting taxed short-term gains. So it just adds into your whatever your salary income is, and that's the tax. So there's more tax implications, right? Obviously, you can invest in Q yield in a Roth IRA or your 401k if you happen to have like in-service rollovers and you're pretty much managing your own 401k. You can have this in there and you won't get those tax implications. So this one's, it depends really. And for Qs itself, you don't have this protection, right? You take on the full risk of the market because Qs is basically one of the big indexes of the market. So it essentially is the market. So when it pulls down, you don't have any protection, like unless you hedge with, VIX or some other thing puts, right? And then it obviously has less dividends than Q yield, not the 1%. And of course, it's more volatile because some months it'll be popping, you're making a lot of money, and other months it's not doing anything. And then there's months where it pulls back significantly, right? But like everything in life, right? High risk, high reward. So the Qs has potential for significantly more returns, right? It could potentially, outbeat Q yield most of the time actually. And I'll show you guys this in the chart so you can see it more clearly. So right now, Q yield, so let's first touch base on the capped gains, right? So March, so this is the COVID crash here. And we bottomed at 14 and March lows, right? And from March to September, when the run finished and we started consolidating, so say if you bought Q at the bottom, right? You would have made 37%, right? Unless you bought here, then you would have been broke even. So that's two scenarios, right? Let me write that down. So bought right before COVID crash. So two scenarios, right? If you bought March lows, 37% gains? Break even. So when I say break even, I mean break even on the underlying position, right? Because obviously throughout this, you're still getting paid out dividends, although much less, right? So let's see at March, how much did we get? So 18 cents. So actually that's really good, right? You potentially still got pretty close to your 1% anyway. So you would have still made that $5,000 had you had 500K for this month, right? So okay, that's good. So now let's compare it with the Qs. It's underlying. So let me remove the drawings I had here. March crash. Okay, so we were looking at March to September, right? September. Right there, okay. So in the Qs, had you invested at the bottom of March lows to September here, you would have made 87%, right? So that's essentially 50% more than had you just waited in Q yield. And you can see what I mean by capped gains, right? Because on this huge bull run, Q yield was probably getting exercised on their covered call. So, they get exercised here, they have to rebuy a little higher. It keeps running, they get exercised again. They sold at maybe it's slightly lower than where it's at. They buy in again. So say they bought in here at 179 for the following week. And they always buy around the money, right? So say next week it's at 192, but they sold 180s. They would have to sell their shares for 180. They'll still make $10 profit per share, but they lose out on $10 of extra profit, right? And that's kind of how Q yield starts to lag behind, because each time you're losing your shares, you're selling it for slightly less than what it's trading at, right? So even though you can still get that full, you still get upside, you get capped because you're not getting the full move, is what I'm saying. Okay. So you lose out 50% had you bought March lows, and if you bought right before the crash, so that's here, right before the crash to that September, 30% profit still. So in the previous example of Q yield, if you bought here, you would have only broke even, right? Because the September was right here. And if you bought here, actually you weren't even break even yet, almost break even. But because of that, 5,000, well, actually it's 3 months, right? So you still made, the dividends. It will probably put you pretty close. But when I say break even, I mean the underlying stock price, right? But yeah, so in this scenario, Q yield in this run only made 38%, whereas Q's made 80%, 87%, so 50% more. So let's write that down so we can see it clearly. Cap gains, 50%, it was 37%, sorry. 37% on March to September bull run. Whereas this guy, potential for more, right? Made 87%. So in this scenario, you would have made way more money if you just invested in Qs outright, and it wasn't, you know, monthly income, right? So you have to make that decision yourself. Do you want just, you know, slow but guaranteed monthly income, or like potentially make a lot more money? And obviously diversity is key, right? You don't have a portfolio 100% into Q yield. No, you might want to have maybe 30% in Q yield to get that income, right? To give you cash so that you can invest it further into some other assets. And then you'll have another maybe 30% into Qs, and then your final 40% in something else. And obviously part of that is also liquid cash. So when there's good deals, you can take it, right? You don't want to be fully invested and be stuck when, you know, opportunity arises. Okay, so now we want to go over the exposure to downside. So a good example, same thing. Let's go QQQ this time. So here is the COVID crash. Top of COVID crash to the bottom of COVID crash, you lost 30% if you bought Qs. Q yield, top of COVID crash here. To the bottom. 27%, right? 28% if you round it up, because it's basically that anyways. So you would lose 2% less, but remember on the way down, you're still getting your 1% monthly dividend. So technically you're losing less, right? So maybe 20 to 25%. So that's kind of where the protection comes in, right? Because Q yield, as the price is dropping, they're still going to be selling covered calls. Okay, maybe they get exercised, they'll just buy it again and continue to sell, right? So no matter what, they're going to still sell covered calls to bring in income, which will give you that guaranteed payout every month. So in this scenario, COVID crash, lost 28%, but technically, you know, actually it's hard to say because it depends how much you make, right? And the payout's only 1%, so that's my mistake. So if it's 28% and you have dividend payout 1%, you actually only lose. So plus 1% dividend, total loss is 27%. Whereas over here, you take on the full risk of the market, right? You lost 30%. And on the way back up, you don't really get that dividend payout still, but remember, potential for more because of the run. And that's what I mean by more volatile, right? Because if you look at Q yield, like look at these months, right? It didn't do much, right? And the swings are a lot closer together. Whereas Qs, same pattern, but you can see how much more it moved down and up, right? And you can see a lot of these like more movements within it on that run, whereas Q yield, it's more of a, you know, a gradual move up, right? So I guess what I'm trying to say is like your account won't be like fluctuating all crazily because there's not much volatility. So we covered this, less dividend payout, yeah. Protection from downside, you saw that because on the way down, it was only 28% versus the 30%, but you also had the 1% dividend, so actually total loss 20%. Oh, so it's good when the market isn't doing anything, right? So in the Qs in this month, when the market wasn't doing anything, so from September to November, it didn't do anything, right? You lost some money here if you sold, but you know it came back up eventually, and then it finally made this next move. But in this time period, price just went back and forth for Qs, right? And the dividends isn't really significant at all. And I think they pay out on a quarterly, so yeah, I don't know, nothing. Probably I got nothing here. Whereas in Q yield, in those 3 months, even though the underlying didn't do anything, it's only $2 difference, right? Versus Q yield, which is like, you know, significantly more. But anyways, you still made your dividend. So 3 months, you would have made $15,000 still. You had 500K in there. Whereas in the Qs, your 500K investment wouldn't have done anything. You actually you would have seen the numbers drop here, come back up, drop, come back up, and finally, when the Qs broke out, is when your 500K would have made money, right? So when the Qs did this part, you would have made money. So theta gain, right? That's what they do. They just sell covered calls and collect premiums. Essentially, this is what QYLD is doing. So like I was saying, if you guys want to invest in QYLD, I mean, there's no issue, right? There isn't really a reason why you shouldn't. You're gonna get passive monthly income. You get some protection from downside, and when market isn't doing anything, you're guaranteed monthly income still, just like that example I showed. But you know, you might not be able to catch the full move, and obviously you're still gonna lose some percentage on the underlying, like we saw here. And your monthly dividend, depending on if you have it on a taxable or non-taxable account, the tax implications might be a little different. Q's high risk, high reward, 87% move compared to just a 37% move from QYLD. More downside because here you lost 27%, but Q's lost 30%. Dividend isn't significant and it's more volatile. But yeah, guys, diversity is key. Just have some into high-paying dividend stocks like QYLD, or JEPI. Sorry, that just tracks SP 500 and it's pretty similar to QYLD. So yeah, diversify it. Have some into the ETFs. Have some in QYLD. Have some cash because you always want to take the opportunity when it arises. And speaking of Qs, there's even triple leverage of Qs called QQQ. Basically 3x, right? This thing's even more volatile, but obviously the more risk, the more rewards, right? So in that example of March lows to the September, right? TQQQ made 470%, whereas the Qs only made 87%. So that's definitely more than 3x, right? And then from the COVID crash to the bottom, you can see it, you lost a lot more, right? 70%. So that's where I say high risk, high reward. But you know what? In the long term, I mean, depending on what your retirement horizon is, right? I mean, it went up no matter what. So this is what, the 08 crash? No, that's the 18 thing with the feds. 08's probably gotta zoom out. Well, it looks like it wasn't concepted yet. So anyways, so this crash, the Qs experienced it too, but obviously it went back up eventually. So TQQQ, if you want more risk, you can invest into this too. But yeah, guys, that's all I wanted to talk about today. Really really appreciate the support. Definitely like and subscribe, and I'll be sure to drop more videos. Thank you, guys. Have a great weekend.